when we sum up this episode and think through, like, what are the things that you should actually negotiate to reduce your transaction costs? It really comes down to service fees. And the most expensive ones are buyer agent fees, even if that shows up on the seller side. If you're paying a traditional 3%, 2.5% agent on $1 million purchase, I mean, that's 25 to 30 grand that it's got to come out of somewhere, and the seller's not just paying it out of the goodness of their heart. Hey, y'all, and welcome back to yet another episode of Disclosures with Nick and Dave. I am your host, Nick, along with my wonderful co-host, Dave Miller. Dave, what's going on, dude?
Not a whole lot.
No?
No, just out here doing all the real estate things, watching the market.
Yeah.
Checking up on our listings.
Yeah. I mean, hey, we had one that went pending after just 2 days. We went live Friday and pending on Saturday.
Yeah, that always feels good.
That feels great.
Probably not the best moment to admit I was out of town for it. So
I'm not saying
I'll serve you the credit you deserve. I'm not saying that
correlation is causation, but there was correlation. It was
if what you're saying is that I need to leave town on vacation more for more offers to come in. Yeah, that could be the best thing you've told me all year, actually.
Right, yeah, exactly. No, the way to see the silver lining. If we could figure out how to reverse engineer that so that I could leave and you just handle everything.
If you figure that out, let me know. I'll do my best to squash it.
Perfect. Well, for anyone who's new here, we've spent the last few weeks really just trying to look at different fundamentals of a transaction. We've talked about renting versus buying, the tax differences between living in Washington versus Oregon. This most recent episode, we had talked about builder incentives, and all of this really just trying to help educate homeowners, home buyers on what really doesn't get talked about enough in this industry. And so next in line with just our absolutely riveting episodes, we are here to talk about the buyer-borrower closing cost estimate sheet, which feels like a mouthful. It's not the most...
It is.
Yeah.
It is a mouthful.
It is, yeah. Buyer-borrower closing cost estimate sheet. We got to figure out a way to make that roll off the tongue a bit better. We'll work on that throughout the episode here. But, it's like, who listens to a full episode talking about just line items on an estimate sheet? And I suppose it's somebody... Nerds. Yeah. Somebody who really does want to understand what's on there and what can be negotiated, what can't, how they could potentially save themselves some money. And that's really the whole goal of the show. We could just get into hot takes on, agent gossip, but
yeah,
doesn't really help people in the goal of transacting real estate.
No. And if you're listening, I think that hopefully the theme, if this is your first podcast you're listening to, or you've tuned into a couple of them, is that we're trying to talk about stuff that oftentimes gets glossed over by your agents, like kind of the hurry up, make a sale, and then your mortgage officer, the title, the closing agent will explain all this to you. It's like, well, at that point, it's a little late, right? Like, it's a little late if no one told you that you can shop for which title company you use. And like, I remember the first home I purchased and the agent who helped me, the agent was great, but I didn't really know a lot of what was on this sheet until I was seeing it for what felt like the first time,
right?
At signing, right? Which you're late to the game. So you don't have to be an expert in any of this. Yeah. This is stuff that hopefully your agent is advising you of, and your real estate agent and your escrow agent can also help answer these questions, and your loan officer. But I'd say from what I've seen in general, there's a lot of people, it's just not explained very well. So there's your warning. It is a little boring, but it's also important to know.
Yeah, absolutely. If the real estate agent is to be like the quarterback, we're not pretending that the real estate agent should take the position of running back or wide receiver. The lender and title company, they do play important roles, but the quarterback should probably understand what the plays are, what roles those other players on the field serve throughout the transaction, and be able to explain that well. So let's get into what this closing estimate sheet even is. Like, who provides this? At what points throughout the transaction do you get it? Because that in and of itself can be a bit confusing.
Yeah. Yeah, and it's important to know because you're going to see throughout the process multiple versions of what seem like the same sheet, but they all maybe change a little bit from point to point in the transaction. And so the buyer's estimate sheet is exactly that. It's an estimate of the costs, and towards the very end of your home buying process, when right before you're about to sign all the papers, your lender or your title company is going to have to send you this closing disclosure sheet that breaks down all of the different costs based off of whatever deal your agent was able to negotiate.
Yeah. And that final closing disclosure, I mean, that one's like down to the cent, and you get it just a couple of days before you sign and finally get keys to your property. But these estimates that you get throughout the process, they're to just make sure that you're not blindsided by some crazy fee from your lender that's $5,000-$6,000 that you had no idea about, and now all of a sudden you're scrambling 2 days before closing in order to come up with an extra $6,000 of cash. It also is there to let you know that there are some fees that are fixed, that no matter what, they're not going to change. And there are other fees that you can absolutely negotiate. And so I think the rest of this episode, we're really going to run through, okay, what are the different line items, at least at a high level? What are the line items that you're going to see on that estimate? Usually get your first estimate right about the time. Really, we run them for our clients right before they make an offer on a house. Usually by that point, you have an idea. You know what lender you're going to work with. We've got some solid numbers back from the lender. We have an idea on close date. So that's the first point that we can really get a solid estimate. And then we might update it a couple of times before we get to the closing. But we're going to run through what all the different line items are there, what's fixed, what's negotiable, and even of the things that are negotiable, only some of them are really worth negotiating.
Yep.
So maybe you can start us on that walkthrough.
Yeah. So the first thing, and likely the biggest you're going to see is, well, your down payment, right? You if you didn't know, you have to put money down to purchase a house. No lender is going to let you buy a house that you have no monetary interest in. That's for them a bad investment to write a loan on.
Only caveat is if it's a VA or USDA loan.
True. The government will insure lots of bad investments.
Yes, they will. And genuinely, too, a thank you to our veterans who have earned the government backing their home purchases.
And if you don't know that, that's something worth noting, right? Like for a conventional lender, that would be a terrible investment. And as a thank you for service, for our veterans who have served the country, the government says, hey, we're willing to hedge against the possibility of you defaulting on your loan and write what would be considered some higher risk loans. And so that could be its whole own
Sure. And I didn't mean to derail, but just in case somebody's listening and they're like, but
and also that, and once again, in the spirit of knowing what the options are and what's out there, there are down payment assistance programs. And so that being said, to the conventional lender or the FHA lender, it's still, they want you to have skin in the game. But if you can find a down payment assistance program that will help you. They'll oftentimes give you a zero interest loan that kind of acts as a secondary mortgage on the property that you don't have to pay back until you sell. That can be a great way to get into a home for someone. And currently, if your numbers are that tight on down payment, we would recommend and say take serious consideration, because renting might be a better choice for you at this specific junction. But
shout out to the rent versus buy calculator on tartanteam.com.
Yeah, and or if you're more interested in finding out, like, does this make sense, go back and check that other episode out. But in general, your down payment is going to be a fixed cost. If you're FHA, it's a minimum of 3%. If you're conventional, it 10% is the minimum, but 20 is for sure the minimum if you don't want to have to pay mortgage insurance.
Yeah, surprisingly, with conventional, you can get down as low as 3%, but it's highly dependent upon your credit score and those kinds of things. And for most people, conventional 10% and up makes the most sense. If you're doing less than 10%, usually an FHA has more advantages, because their MIPS, which is their version of mortgage insurance, tends to be a little bit less expensive. But more nuance to bring at another time. Point is that with the down payment, not something that you can show up a couple of days before closing and be like, hey, actually, I'd like to bring less. That's not going to fly.
It's essentially fixed. So if you're looking at a $500,000 home, just assume your bare minimum is 3%, and then if you want to put more down to get if you're in a position where you can put more down to save on your total monthly payment and pay less interest, then that makes sense. But as you said, it's pretty much a fixed cost. So from that, then gets into what would be considered the second most expensive, which is your actual loan from your lender. And
loans aren't free, huh?
No, it's funny. They that there's banks and mortgage originators want to get paid to give you money.
I thought that they got paid every month in the interest that they take out of the loan.
Someone's getting paid. I'm pretty sure that's Fannie Mae or Freddie Mac or one of those that they all sell the loans to.
Okay, so they got to get paid on top of the interest that gets paid, is what you're saying.
They do, and so that's
fun.
That's part of, and this is one of the more complicated or more involved costs with the loan. And you're gonna look at this closing. You're gonna look at what are we calling it? The
borrower closing estimate sheet.
Go. I'm just going to point at you and you can say it. There's going to be a lot of different items that fall underneath the loan origination fee, and they're sometimes broken out and they're sometimes condensed together. And so that it really depends on who you're getting your loan from or who you're asking. The main thing to know about this is it's sort of your loan origination fee plus any other title or plus any other administrative fees that the lender is adding on. It's kind of that total number at the bottom, and they might break it out differently. But the thing to know about this is you need to understand lender to lender, regardless of how they're breaking it down, it's the total number that makes the difference, because they might shift. Like one lender might say, oh, your origination is 7/8% of the loan, and then they're going to have a bunch of extra fees on top of that, like an administration fee, a processing fee, and all these different things. And it's none of it's standardized, right? It's all they can kind of call it what they want, or you might just get a lender that's going to just say 1.25% is the loan, the origination fee, and there's going to be nothing else. So the thing you have to be discerning about is what is the total in lender fees, and the reason that matters is we find that this is the one item on the sheet that's actually the most worth shopping for,
Right.
right?
Absolutely. Yeah, it's kind of funny because every lender does have to send you like their own estimate sheet, and this is a standardized form that it's part of like the Truth in Lending Act to just make it very clear what all of their different fees are, and in addition to whatever the advertised interest rate is, there's a total APR that's inclusive of all fees, and this
So APR
Mhm.
stands for actual percentage. What's the
Right.
last? Sorry, yes,
Yeah.
actual percentage rate.
You're getting
So
there. Yeah.
takes me a minute
Yeah.
sometimes. But so what does that mean? It means if you qualify for an interest rate for the loan, but if you add in all these extra fees into your loan, the actual interest rate you're paying
Yeah, it
is
can be
increased, right?
significantly higher,
So that's
potentially.
something worth knowing is your APR is kind of the final number you want to be looking at. Sorry, just wanted
Yeah.
to
No,
jump in.
That's really good and helpful because, it can kind of start to feel like you're shopping like cable companies versus streaming services, where the cable company has it all bundled together in one fee that looks really high up front, and then the streaming services will compete with like, hey, you can get all of this for this much lower fee, but then all of a sudden, once you've bolted on all of your streaming services, it's like, actually, that might be a lot more expensive. So anyway, it can get fairly convoluted when you're trying to shop different lenders, which is why we always recommend that you get 2 to 3 quotes from different lenders so that you're able to make sense of these fees. And this is one of the things that we really love helping our clients with, is actually comparing those different lender sheets from one to the other and helping you determine which makes the most sense. Now, this is an area where you could potentially save $3,000, $4,000, $5,000 by one lender versus another. Would you say that you should always go with the cheapest lender?
It's a good question. It depends.
I had a feeling that one was coming.
Our
Yeah.
favorite caveat.
Yeah. Yes.
No, so to maybe break this down a little bit, I think inherently everyone understands that on some level, unless you're talking about people who are expensive just to rip you off, you're going to get what you pay for, right? And so if you've never gotten a loan before, you might not understand that there are standalone mortgage origination companies, and all they do is write loans, and then those loans kind of all get consolidated and sold to either the government or a big investment company.
Yeah.
That's getting into the nuance of the back end of the mortgage industry, right? And how that ties into the rest of the economy.
But surely, like, everyone's heard of Rocket Mortgage or Loan Depot or just one of these huge online platforms that.
Yeah, and so you have individuals, and then you also have these large companies that are online and maybe less personal, and then you also have more local places like your local credit union also might write a mortgage for you, or one of the big national
US
banks.
Bank or something,
exactly. So the thing to think about is, it's like, well, to your point, Rocket Mortgage, I don't think they're affiliated with TurboTax, but it's like you could pay a personal accountant, or you could get TurboTax, right? To file your taxes. And I think inherently everyone understands, if you're paying an in-person individual that wants you to come sit down with them in January as you're getting ready to file your taxes, you're probably going to get better advice. You're probably going to get more optionality. You're going to see, it's just going to be a much more personal experience. And for some people, like if you have really complicated taxes, that can be money really well spent. The cost of employing that individual is far offset by the money saved.
Yep.
Okay. So how's that look then for mortgages? In general, you could classify some mortgage. We're trying to keep this in the realm of buying a house. Some houses, if you're coming with little money down and maybe you don't have the greatest credit rate, or this is a really high stakes buy for you like a couple years ago when the market's really hot.
You're self-employed and have different streams of revenue that are non-traditional,
Yep, absolutely.
unique property that's hard to appraise.
Right. All of these are factors that might indicate to us to advise you to go with somebody we know and trust individually, who's an individual who works in the loan origination space.
Yeah, knows the Clark County market.
Absolutely.
Knows the appraisers, has a personal relationship with those folks, can get really creative, is going to give the attention to detail to you in your specific situation.
And so maybe if you've never gone through a sale before, you're like, what are these guys even talking about? If you make a deal or if you go under contract on a house that's contingent on your financing and your financing doesn't come through in time, depending on how you wrote that offer, you at a minimum could lose the deal. In a really bad case, you could lose your earnest money if the deal falls out in a really competitive market from looking from the buyer's perspective, right? And so going with somebody where it comes in is trust and having a reference for somebody who can pivot with these things that inevitably come up on harder deals. Now, would we recommend the most expensive for somebody who's putting 30% down on a house in a buyer's market where maybe the house has been sitting on market for, I don't know, 60, 90 days already and they haven't had any and we get a really good deal or we get a really good offer for our client? I don't know. What?
No, it's the same kind of thing, right? Like if you're a W-2 worker with no weird financial situation and just kind of doing like average normal stuff, like TurboTax makes a ton of sense for you. You really don't need to have a dedicated CPA going through your stuff. Similarly with mortgage, like if you're doing a very straightforward down the middle, this is a house that's going to be easy to appraise. You got nothing weird in your financial background. You're coming in with strong financials, then yeah, it probably makes this sense to go with the most affordable lending option.
Yeah.
Because the risk is just so low that, I mean, that's really what it comes down to is that like, when you need to get somebody on the phone who knows you, knows your situation, and is going to go to bat for you, that's where working with somebody locally who generally they tend to charge a bit more for that expertise and personal touch, but that's where it's really worth it. But if the chances are low that you're going to need to get that person on the phone in the 11th hour, it's a little bit of a risk you take, but you can get a better deal that way.
Yeah. Yeah, super good to know. To maybe sum it up, it comes down to risk. If you have a low risk deal, if you don't have a lot of factors that would lead us to say, hey, maybe we should go with a smaller lender. Or if you have a relationship already with someone it's not always this. It's not about keeping a referral network alive, and there's a lot of disclosures in the real estate and mortgage industry of like real estate agents are supposed to tell you, hey, we work with this guy. You don't have to work with him, but we like this person. And so it's not a lot of agents, to some degree, it's a good old boys club in some cases, but in a lot of cases, hopefully your agent is really advising you of like, hey, it makes sense to use this person in this instance. Or if you don't have the more complicated, then definitely get that Rocket Mortgage quote and see if it's going to save you the money, right? Like that's why our recommendation is always, if you know somebody, check that person's price, but also shop around and see. And if it turns out that for your instance, the potential cost savings is really small, less than $1,000, not to sound flippant, $1,000 is still $1,000, but would you really want your deal to fall apart because your financing didn't come through?
Yeah.
So,
and the last thing I'll say on this note is just, we've got 4 different lenders that we have good relationships with, and that if somebody needs a recommendation, we always make that a tailored recommendation or introduction. So it's not like we just have this handshake deal with just one person in Clark County that we're trying to funnel everybody to. We're really not trying to funnel anyone anywhere other than trying to help make great introductions to good professionals doing good work. And adjacent to that, the other benefit on getting like 3 different quotes from 3 different lenders is that these closing costs, origination fees, underwriting, admin fees, all of that kind of stuff, it's all negotiable at the end of the day. And so even if you have a lender that you really like, but they come in with higher fees, you can show them, hey, I got this other quote from this other company. Is there anything you can do to sharpen the pencil and become more competitive in the numbers? And they'll be honest with you of, yep, hey, actually, we can reduce these fees here and here, or they can't. But that's the other benefit in just trying to get leverage. Of course, we've camped out here because this really is the biggest one, the biggest area where home buyers should shop services. It's going to be the thing that makes the biggest difference long term, both because you could potentially get a lower interest rate, certainly potentially a lower overall APR. And those are the things that like month over month, year over year really can make or break the financial scenario around your home.
Yeah, absolutely. It is the one bucket that really moves the number on your monthly payment, which right now, with rates being what they are, that's the month-to-month cash flow is what deals really are living and dying by. Yep. So with the sort of the origination fee, things that people think are tied in are the appraisal fee, which a lot of people will see that, and a lot of lenders will ask you to pay for that out of your own pocket, because if the deal falls apart, they don't want to be out that money. They want you to pay for it, which makes sense for them, right? And a lot of people are like, oh, why do I have to pay this? It's like, unfortunately, in a lot of cases, almost every case, the lender gets to pick the appraiser that they want to use. And so maybe you heard your buddy Steve next door just wanted to know what his house was worth, and he had it appraised, and it was only $200, and you're like, why the heck am I paying $750 for this appraisal when Steve had it appraised?
Getting gouged.
Yeah, exactly. Well, Steve might be friends with the appraiser, and he might have just done it on the side. Typically, this, even though it's not, it's an item that's chose by your whoever you're getting your loan from, your lender. You don't really have an option. And in general, within an area, say Clark County, you're going to see roughly the same rate from one appraiser to the other. If you hear something really low from somewhere, it's a safe bet that the circumstances around it were different and different market. Maybe it was a friend doing it on the side, not actually for a lender. But yep, in general, that's another fee that often comes in and looks like it's under the origination or the lender's cost, but it's really something you pay for directly, even though the lender is the one who chooses which appraising agency they want to use.
Yeah, absolutely. And kind of just what you should expect to see there. Generally, $500 to $900. That's because usually an appraisal somewhere between like $400 and $700, depending on the size of the home. And then, of course, there is a bit of the markup that that the lender has, because they're having to coordinate it and then have to make sense of it and file it, and part of their underwriting process. So, but well described. Yeah. That's something that the lender handles, and by and large, it's a fixed fee. Home inspection is one that people ask about. It's not actually one that usually comes up on this closing cost estimate for buyers, but I still think it's worth mentioning here, because as buyers are trying to think through, all right, what are the total costs throughout this process? Kind of like the appraisal fee, this is the one that may be due prior to closing and can be another $600 to $1,000, $1,100. I mean, depending on the scope of work and how big the property is, it can be costly.
So, and that goes back to what we said initially of, it seems like you're going to see like a couple different versions of the sheet from different people.
Yeah.
So that's something to note with the home inspection is that a lot of the time, if you're interviewing real estate agents and they say, this is what we think it's going to cost, you tell them kind of what you're looking for roughly, and they guess, they put in a rough guess on the home price you're going to see, and then they put in some of these other things, but maybe they leave out the home inspection. By the time you're seeing the official borrower cost disclosure, or whatever, what is the term we said? Buyer's
borrower cost estimate sheet.
So by the end, the final one you're seeing is no longer an estimate sheet. But at that point, you've already paid for your home inspection. And so you don't oftentimes see it, but it's, as Nick said, something, because that last sheet you're seeing is from your lender.
Yep.
And they didn't necessarily have anything to do with the home inspection. Now, sometimes, depending on how you're paying for everything, it might sneak in there, but more often, if your title company is maybe funneling money to make sure everyone got paid, so that there's no weird liens on the property or anything. But for the most part, you're not going to see that on the sheet. But it is another $600 to $1,000 roughly is what we see around here for your averaged $500 to $1 million home.
Yep.
What do we typically recommend of like, well, it's 500,000. Should we even be doing this? I mean, it is something that's shoppable for sure, right? Like, since it has nothing to do with the lender, you can find someone to give you a real good deal.
Yep. And I've truly seen it all, from people doing no inspections to having like a family member do the inspection for free because they've got a contracting background, to people doing the full works and spending upwards of $1,400 on inspections. So there's a gradient here. I think our recommendation is always that you have a home inspection done, and that this is not an area to cheap out on. Again, similar to lenders, we've got some phenomenal home inspectors that we've got relationships with and can recommend to you. But at the end of the day, that's a decision that you need to make. I wouldn't trust a realtor who said you have to use this person because there's just too many realtors that they want to see the deal go through, and so they know an inspector that's going to go soft on the report. That's not the folks that we recommend. But at the end of the day, like, we want for you to have the relationship with the inspector so that if you have concerns, you can call them. We'll do another full episode on home inspections and how to, understand the report, how to use that for leverage and negotiations. In general, though, it's cheap insurance, cheap peace of mind, and oftentimes the inspection more than pays for itself in the negotiations that it opens up with the seller based upon the findings.
I'd say so. The one caveat would be maybe if we see another 2022, 2021 sort of situation where you're just going over asking by tens of thousands of dollars over asking price. At that point, there were a lot of agents who were saying, your best bet, if you're just like, people, there's every house is getting 10 offers on it. Your best bet might be to just say no inspection contingency, save the money, and get people really well who could, whether it's a home inspector, your family member, friends, or contractors, and essentially kind of try to do your own home inspection while you're walking the property and maybe go through it 2 or 3 times. That's kind of the one scenario. We've kind of moved past that the way the market is currently, but that was definitely a strategy, right. 2 or 3 years ago when you didn't have a lot of leverage, because to maybe try to close this up quick, but if you just think about what's the point of paying $1,000 for an inspection if you already went $30,000 over asking and you are not going to be able to negotiate anything? Now, the obvious answer to that is clarity, eyes wide open. And that is good, and we'll still recommend that in a lot of cases. But if you really want the house, that might be something you elect not to do and try to discern yourself.
Yeah. And that, situation by situation, more than happy to talk through just negotiation strategy in a competitive market, because there are still things we can do to protect you while making your offer as attractive as possible. But good on home inspection. Next one here. This is we're starting to get more into escrow and title fees, and so a big one is title insurance. Title insurance is something that trips people up because there's two policies with title insurance. One is the policy that covers you as the new homeowner, and this is one that the seller pays for. So the seller's paying for title insurance that shows that you have clear and free ownership of the home from anybody else that comes to make a claim of it. There's a second policy, which feels so redundant, but I'll keep my opinions out of this, that you as the buyer pay for to cover the lender. So it's the lender's title insurance policy. So one of those obviously irrelevant to shop for because one, the fees are set by the state, and two, the seller's already paying for it. But what's your level of comfort diving into the lender's title insurance policy that you as the buyer have to pay for? Some lenders do give you the option to not have it. Is this something that you can shop? What are your thoughts here?
So it's interesting. You can technically, I believe, shop both. In a lot of states, as you said, the rates are set by law. I think in more cases than not, across the board, the policy premiums are going to be almost the same.
Okay.
And the actual premium price might be a little bit different. We're talking less than hundreds of dollars difference in the prices of these policies. And they're usually a percentage of the sale price of the home. Actually, forgive me, the loan price of the home in a lot of cases.
Okay.
Specific on the lender's title. The lender's title policy is they're insuring the loan that's on against the home, right? So if you put a huge down payment down on an expensive house, that policy is going to be cheaper. In general, the majority of the cost is going to be sort of the administration fee that is coming along with them doing what's called a title search. So they're looking at the history of the deed. The deed is what says someone owns the house, and it gets written in of who the new owner is, every time the house gets sold. And so they're looking and they're trying to see if there's, some long lost, an old couple died and their kids don't want the house. So they go to sell it, and there's three sisters, and two of them, the third one's estranged, and two say they're going to sell it, but they don't get the third sister to sign, who technically had a claim. And then the sister 3 comes back and says, no, I didn't want this house sold. And this can happen even like 2 or 3 buyers and sellers removed. So this doesn't even have to be the person you're purchasing the house from. It could be somebody who they purchased the house from, or even further back. So the lender, as is always the case, they're trying to assess their risk in their investment into the property. And if somebody else technically has a claim to the property, that could really hurt. If you get kicked out and you no longer own the property, you're not going to have much reason to pay that loan, and you default. So all to say, that's the mechanics of it. But more often than not, the actual policy price is almost the same, irrelevant. You really see the savings when you work with a title company that also writes their own insurance policies. So one of the companies we work with the most is Chicago Title, and they actually have access to writing their own insurance policies. So what we're saying is smaller title companies might actually buy their insurance from a different title insurance company. And so there's sort of an efficiency that comes from working with somebody whose systems are all synced together and they're not doing duplicate tasks on their ability to write a title insurance policy and close the sale of your home. And so once in a while we run into customers and they'll be like, oh, I know my aunt's a title agent and they want to work with a small firm. And if that's your choice, absolutely do that. But just know that you may end up paying more in fees. Are we talking a crazy amount? No, we're talking in the hundreds to maybe $1,000, right? This isn't nearly as big of a deal on the sale of a home as the loan origination cost, right? And so it's not something really worth stressing about. The recommendation we would come to is to go with a company you know and trust, or if you don't know anyone, hopefully you trust your agent to give you a solid reference for a company. I don't know, any other...
And a company that's been around and will be around for a long time, seeing as they're the ones that handle all of the money, including all of your earnest money deposits.
Yes.
And you don't want them going under overnight. Not that we see that happen very often with title companies, but that is why we really like working with Chicago Title, who's one of the biggest. But there's WFG National Title, and Clark County Title is another local one. But so basically title insurance and then escrow fees, it's all kind of jumbled into one bucket because the title company and the escrow company and the closing agent, where they act as the third party throughout the transaction, it's all kind of under one roof, right?
In most cases.
Yeah. And so, like, if you did want to shop WFG versus Chicago Title versus Clark County Title, you could ask them for like a fee schedule based upon the price bracket that you're looking at, and you'd be able to get those side-by-side comparisons. But this is, like you were saying, truly one of those areas where you might stand to save $1,000. Again, not nothing, but if your agent already has a relationship with somebody that's reputable, that's known for being organized and on top of things, it's probably not the most important area to spend your time. Far better to shop lenders and realtors.
Yeah, absolutely. I also wanted to back up real quick and just put one note in that is maybe almost not worth mentioning because it happens so infrequently, but you don't actually by law need to purchase the homeowner's title insurance policy. So what that means is the one policy covers the lender if a claim comes up, but if that sister who thinks they still have a claim to the property comes up and goes after you, and you didn't purchase the owner's title policy, well, now you're going to have to fight that claim in court out of your own pocket. So out here in Clark County, more often than not, the seller is purchasing that for the incoming buyer. And so it's kind of like one of those things that just sort of auto gets penciled in. But in some places, you might not, that might not be the standard. There's other states where sellers don't often it's not customary, we'll say, for the seller to purchase a owner's title policy for the incoming owner, in which case, most of the time, our recommendation would always be to purchase that policy, especially if it's coming in with the lender's title policy. You get those economies of scale of all the title search fee and all of it. It's usually no more than a couple $1,000, and it's the land dispute lawsuits are incredibly expensive and can be very drawn out, and it could in a lot of cases be the best insurance you purchase.
It's cheap peace of mind to know that your property isn't going to get pulled out from underneath you.
And I give the example of the sister coming for you, and that's a really extreme example, but more often than not, it's small clerical errors that can create issues that get caught later on, where if you ever are going to sell this house, you want to be able to deliver a clean title to the next purchaser of it. And if there's what would be called a cloud on title, and that could be because of a number of things, but a lot of the time, even just small paperwork or filing errors, that stuff can be really costly to resolve. Oftentimes, if you had even one claim more than the cost of the policy. So
yeah. So, I mean, just to sum it up, with your title and escrow fees, this is something that you can shop. There are fees in there that aren't exactly fixed, but in most cases, the savings aren't huge.
No.
But still good to understand. Now, there's another bucket of essentially prepaids. So this is homeowners insurance, tax reserves, your escrow account is what they call it, some prepaid interest. Which of these are fixed? What can you shop for or negotiate, if anything?
Yeah, not much.
Okay.
Not much. It's if you haven't seen it before, you may look at the end and be like, "What is all this taxes and insurance?" And it could be anywhere between a couple thousand up to 8, 9, 10,000, and it really depends on where you are during the year. And if you're sort of at the beginning of the year, they might want you to pay your first half of the year taxes and your full year's homeowners insurance, and as well as you're going to see the deed recording fees, some of the other county fees, and that's all going to be at the end. And it could be like $5,000-$6,000 on a home that's between, we're keeping it in the range of 500 to $1 million. And it's like, what is all this other stuff? It's like, well, you were going to end up paying that regardless. And so that escrow account, they're taking your money ahead of time to ensure that it gets paid to the right people. The lender wants all of that property tax and the insurance up front so that they're in control of it, and they can make sure that gets sent to the right people.
Yeah. They have an interest in making sure that your home is insured and that the tax liens don't come against the property. So they will make sure that those things get paid, and they will make sure you pay for them by putting them in this escrow account. Now, the homeowner's policy, that is something that you get to shop for.
Correct.
And that can really be big. Like this is, again, just locally, we recommend the Van Clark agency because they do homeowners, auto, life, like anything that you need for insurance. And they work with all the different insurance companies so that they're able to really bundle together a great package. So like when I was originally shopping on my own, whatever it was, Safeco or something like that had sent me a policy to review that was like $2,000 a year. And then when I went with Van Clark, they came back with something that was closer to $1,100 a year. I picked that one, and it was better coverage because I'm smart.
Yeah, this could also be its whole own topic.
Yes.
But everybody's seen a commercial talking about bundling and saving. It's like, what is that really? It's back to what we were saying in both title company insurance and loan origination. It's efficiencies of scale, right? If they already are inputting your information for your home, but they're also getting your auto policy, maybe some life insurance, you're going to get a better deal on
Is this a good time to let everybody know that this episode is brought to you by Jake at State Farm?
Yeah, Jake at
not State Farm, just Jake.
Jake
at State. Yeah, he's the paid sponsor for this episode. So shout out, Jake. Thanks.
You gotta generate some customers somehow. Yeah. What did we get paid for shouting them out?
Nothing yet. We're working on that.
It's a commission share,
as with all of our sponsorships. But yeah, so again, that would be a great topic to really delve into. But that's the one thing that you do get to shop for yourself.
In general, taxes and prepaid interest and any of those other county level recording fees.
Can't negotiate your taxes.
You can try, actually.
That's yeah. When the assessment comes out, there's some options there, but in general, no, can't, and certainly not as part of closing. For anyone who's still stuck around, almost an hour in, anything else in there? These like recording fees. There's there just always feels like there's a bunch of like $20 to $200 fees, maybe 5 of those. Worth mentioning. It's just
in general, no.
Can't negotiate them. It's just
for the most part, not
little cash grabs here and there, and
feels like you're just slowly getting bled out. But I think that's kind of what everyone's feeling nowadays, right?
Yeah. Any good news?
Yeah.
You get your earnest money back.
That is the good news, right? Is oftentimes whatever money you put down to get your offer accepted originally comes back as a credit on the closing disclosure, the borrower's cost disclosure at the end. And so in a lot of cases, if you already put down all this money, you don't have to come up with even more money for some of these fees. And that really goes into how the deal ends up getting structured and the financing. Sometimes that's the case, sometimes not. But no, we'd be lying if we just said, "No, yeah, go for it." But that was how we started the episode, was saying, you should go into this having like a solid understanding of what it actually costs, because so few people don't. So few real estate agents are really explaining this, and then you put all the time and the effort, both effort in showing up, but also emotional effort, and you get your offer accepted, and you're going through the process, and then all of a sudden you feel like I feel a little far down this rabbit hole. So the best thing to do is to be educated on the front end. Yeah. And listen, if your real estate agent is averse to questions and they don't want to go through this stuff with you,
yikes.
Well, yeah, and hopefully you're working with a great agent and they are explaining this stuff to you, and it's not just sort of push them on and then let the real estate, the loan officer or the escrow agent explain all these extra costs to you. At a bare minimum, hopefully you knew that some of this was coming.
And not to like drag this on, but I feel like we'd be remiss to not address this explicitly. And perhaps I'll cut this and like put it at the beginning of the episode. But absent from this list is real estate agent fees. And the reason for that is because historically, traditionally, even in most transactions now, the buyer agent commission shows up on the seller side, not on the buyer side of the estimated closing costs. And most of the buyer clients that we work with, that's still the way that they want us to negotiate their purchase and sale agreement, is so that the seller is paying our fee as a seller concession or credit. But if you're going through this and you're wondering like, how do Nick and Dave get paid, and why doesn't that show up on here if they're representing me? A lot of agents will talk about how buyer agency is free to the buyer. And this is the reason that it looks like buyer agency is free. But the reality is that when we negotiate our fee in for the seller to pay for it, that does take away it potentially takes away your negotiation power to reduce the price or for closing cost credits. And there are worlds in which it may make more sense to put buyer agent commission as a buyer cost. When we sum up this episode and think through like, what are the things that you should actually negotiate to reduce your transaction costs? It really comes down to service fees. And the most expensive ones are buyer agent fees, even if that shows up on the seller side. If you're paying a traditional 3%, 2.5% agent on a $1 million purchase. I mean, that's 25 to 30 grand that it's got to come out of somewhere, and the seller's not just paying it out of the goodness of their heart. And so that's an area where by negotiating compensation with an agent, finding an agent who's aligned, that's a huge area where you can save yourself a lot of money as a buyer. And then negotiating lender fees. Those are really if there's any takeaways from this episode, I think it should be those two.
Yeah. Great footnote. Hopefully, if you're following the podcast, you already knew that.
Hopefully,
and
yeah.
if this is your first episode and you're like, what are they talking about? Absolutely. All real estate commission fees have always been negotiable. And it seems that in recent time, it has been up until now that it's actually starting to get the press that it should have gotten a while ago.
Yeah.
So I'd say that's a great place to wrap. Your buyer's agent's commission and lender fees, and are the things to shop for and the things that are negotiable. And if you want the buyer's agent commission being negotiable broken down more, we did that in one of the first podcasts talking about how we work and why you might want to start looking at
flat fee,
and absolutely. And also breaking down some of the mechanics of, well, even though it seems like the seller's paying for it, you're still paying for it. No service at some level, you're not going to get a service provided to you for free. So check out some of the other podcasts. I'm sure we'll talk about it again in the future.
Yeah.
But
subscribe to the show in comments. Let us know what it is that you'd like to hear us break down next. And you can always reach out to us, Dave at thetartanteam.com, Nick at thetartanteam.com. And you can book a call. Like if you want to go through any of these numbers or just talk about your situation, thetartanteam.com/book is another great way to just schedule a meeting with us. But thanks for being here. We look forward to catching you in the next one.
We'll see y'all.
Bye.